Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is an oil and energy market expert. He has been working in the oil and energy industry for 25 years now, many different companies, including ConocoPhillips. He's also written a successful paid investment newsletter about the oil and energy business. For people who are asking, this interview is recorded on Friday, March 13th, 2020. Robert Rapier, thank you for joining me again.
Thanks for having me again, Jason.
Now, Robert, you wrote a really great piece early in January 2020, a lot of good predictions in there, and I thought you were going to end up being right on a lot of them. And then all of a sudden, over the last 2 months, the coronavirus, especially the amount of people infected in China, it spread all over Asia, it spread to Italy, it spread to Iran. Now it's here in the United States, and Europe, and it seems to have thrown a big monkey wrench into supply and demand, both of them. I've called this the perfect storm of bearish news for the oil market. How much has the fundamentals for the oil market with supply and demand changed, in your opinion, in just the last 2 months?
Yeah, so this was probably the fastest falsified prediction I have ever made. When we opened the year, the fundamentals for oil for the oil markets looked pretty good. They weren't great, but they weren't too bad. I didn't think we would see a big dip in oil prices this year. And maybe 10 days after I made that prediction, we started getting news out of China that this new virus was really spreading. And even then, I started walking that prediction back a little bit, and I started warning that if this thing gets out of hand, that this could be really bad. And first week of February, I did the Money Show in Orlando, and I told the audience then, I was on a panel on stage, and I said, this could be really, really bad. I said the economic consequences of this could be shocking. And people were like, no. The guy next to me on stage said that the Philippines already has a cure, and it's going to be, nothing. And I said, I don't know. I was really fearful of this. And then, so about 2 or 3 weeks after that, IHS Markit comes out and says, they follow the oil markets very closely. They're one of the world's experts in, watching oil supply, demand, inventories. And they said that this is the largest demand destruction in a quarter ever in history. So, manufacturing out of China was, came to grinding to a halt. People stopped flying. People stopped going out. And so this is real serious, deep demand destruction. And I've often written about disconnects in the markets when, demand looked pretty good and demand was growing and, oil supplies were growing, but, things were pretty much in balance, but oil prices were still depressed. And I'd always call that a disconnect. This is not a disconnect. This is a real event that has slammed oil demand, and it's not certain when it's coming back. So, I've cautioned people now for, since early February, I've been cautioning them this market is really, really risky, and especially the energy names. I've urged people to be very, very careful now in the energy sector because we just don't know how bad this is going to get. And then on top of that, you've got the Saudi and Russia tiff going on. So, the energy stocks have had a double whammy here. They've had a collapse in demand and then a price war, and you've seen really, really good oil companies just get absolutely cut in half.
Yeah, Occidental Petroleum and some of the others dropped 50% in a single day. Earlier this week, they slashed their dividend 86% after telling people over the last month, more than a month, telling hungry yield investors looking for income that they would not cut their dividend. So other oil companies, as far as I've seen, have not cut their dividend yet, but I've been looking at dividend payout ratios of some of these large super major oil companies and some of the independents, the mid-tier ones, and the dividend ratios are above 70, 80%. Some of them are even at 100% or higher. So I don't think that's sustainable unless oil prices rise. Did you see that Goldman Sachs put out a research chart in the last week or so showing that the large U.S. oil super majors, in order to not cut their dividend, 100% dividend payout ratio, and not 100% dividend payout ratio, but maintain their dividend, to cover their dividend and to cover their CapEx bills without cutting their CapEx, they need oil prices at $60 a barrel. So maybe for a quarter or two, these oil companies can survive maintaining the dividend. But, if oil prices stay lower for longer or go lower for a certain amount of time, a couple quarters, I don't think those dividends are sustainable.
Well, I will say this. Shell and Chevron have both managed to continue growing dividends through the financial crisis, through the oil downturn in 2014. I mean, Shell hasn't cut a dividend since World War II. So, and my point is not that they won't, but they have survived some really, really tough times in the last 50 years without cutting their dividends. So it's going to take something pretty extreme, I think, for them to break that streak. Now, if oil prices do stay at $30 and we've got an extended period of time there, then yeah, this could be the thing that breaks that streak. The thing about Occidental, their dividend had gone up around 20%. Their yield had gotten up around 20%. You cannot, people have to know if they're buying a company and the dividend is 20%, there is a problem. And any company, even if a company was covering their dividend at 20%, nobody expects it to stay there. So, they can use this as an excuse to cut dividends. Many companies, even those that are making their payout, could use this as an excuse and say, our dividend is, our yield has crept up to 18%. Nobody's going to blame us if we cut that in half back to 9%. It's still a great yield, and use that cash to sort of, sustain themselves through tough times here. And the MLPs have gotten just battered terribly. Enterprise Products Partners, one of my favorite companies at the beginning of the year, and they've gotten just battered. But if you look, they're covering their distribution. They covered it throughout the financial crisis. They covered it throughout the downturn. They're even more conservative now with their payout ratio. But their dividend yield is really getting on up there. I don't think they will cut. I think that's a pretty, if you look at them, they're pretty conservatively managed. They don't have too much debt. Now, again, if we have a really extended period of oil prices at $30, all bets are off. But I'm hoping Saudi and Russia come back to the table and say, you know what, we're both losing hundreds of millions of dollars a day. Let's try to work something out here.
Yeah, good points about Chevron and Royal Dutch Shell. Their dividend payout ratios are below 100%. So the red flags to me are when the dividend payout ratios are at over 100%. That's something I would look out for the listeners out there. If the dividend payout ratio, and you can check this when the earnings come in, if each quarter, if the dividend payout ratios are above 100%, especially way above 100%, it's going to start to be a red flag. ExxonMobil right now has a dividend payout ratio above 122%. So I'm starting to get a little worried about that. We'll see if they cut it maybe a little bit. I don't know if I expect big dividend cuts, but maybe they temporarily cut the dividend a little bit, like 20% or 30%. That might be the more prudent thing to do. What I would really like to see, Robert, is companies like Chevron and Royal Dutch Shell, which have been criticized for not buying more oil reserves lately. They've been focusing on natural gas for years, growing their natural gas business, growing their LNG business, going in, if there is a big bust and more bankruptcies in shale oil, going in and buying some of these quality oil producers that have lower costs for pennies on the dollar.
Definitely, they could pick up some reserves at very cheap prices right now. And speaking of LNG and Shell, that's why Shell has gotten hit so hard. They're a major LNG supplier, and LNG market has just collapsed in the wake of this coronavirus. China has not been taking shipments, so that's hurt Shell a lot. I think Shell is positioned for the future very well, because I do see us having, moving more and more to natural gas in the future. But right now, this coronavirus just really killed them on their LNG shipments.
Oh yeah, there's been stuff going on out of China that I haven't heard of. You have more experience in the oil markets than I do, but have you heard of large companies like PetroChina or other companies defaulting on contracts like force majeure, which is like emergency circumstances before? It's extremely rare, is it not?
Well, I don't believe I've ever heard of somebody declaring force majeure and saying, we can't take that shipment. And that's what happened. Companies declare force majeure and say, we can't make this shipment because, we had a catastrophic failure in some equipment, or, our country was attacked, or, there's force majeure for all sorts of reasons. You don't hear it very often with somebody saying, we can't take the shipment. Force majeure, we can't accept this shipment.
Also, at least for a month now, I'm not sure if it's still going on, but I heard from other oil traders I was talking to, professional oil traders, it was going on for a month at least, that a lot of Chinese oil companies, the large oil companies, the oil trading houses, the oil refineries, were dumping oil back onto the market as fast as they could for cash. And they were not expecting a bailout. So not only did you have demand collapse out of China, problems with the global supply chain, you have people voluntarily all over the world now not wanting to travel, and then you have travel bans too. But you also have these Chinese firms that were making the vicious cycle, I call it this doom vortex loop, even worse, because they were dumping oil back onto the market for cash when they rationally should not be dumping oil back onto the market because they were only forcing prices lower.
Yeah, exactly.
So I want to ask you about the last time the Saudis tried to kill shale oil. So we were both working and investing daily 2013. The Saudi oil ministers back then were confident that shale oil production costs were $65 a barrel. They thought for sure that within about a year or so, if they didn't cut production at the time, that they would temporarily sacrifice their oil profits and drive shale producers out of business. But shale producers were able to cut costs and also were able to raise capital at the time through junk bonds and equity. What do you think is different this time, and do you think the Saudis, Russia, and United Arab Emirates, which is also increasing production, they're OPEC's third largest oil producer, do you think that they're going to be successful bankrupting more shale oil companies this time with a similar strategy compared to 2013, 14, and 15?
Well, I mean, you're exactly right. So that is what happened in 2014. You had seen shale production expand for a number of years, and it was starting to take a little bit of market share away from OPEC. And so they decided to declare a price war. They I don't know if you recall at the time, oil prices had been $100 for, mostly $100 for several years. But in the fall of 2014, they had started to slip as U.S. oil production growth continued to outpace demand growth. And so prices started to get a little bit soft. And I think then OPEC decided, hey, we'll increase the pain here. We'll cause prices to drop to $60 by ramping up production. And, within a year, half of these guys will be bankrupt. And so that was what I deemed their $1 trillion miscalculation. They opened up the taps, and they attempted this strategy for 2 years. And they really underestimated the resilience of U.S. shale producers. Now, some did go bankrupt. But banks continued to loan the other ones money. They became much more efficient. We did see a dip in U.S. oil production in 2015. That was the first dip since the shale boom started. But most of these companies they survived. They made it through, and they were stronger. And in the meantime, oil prices dropped all the way down into the 20s as a result of this price war. And then after 2 years, Saudi finally waved the white flag, and they said, we've had enough. We're going back to defending prices. Now, that has its own problems. If they're going to defend prices, they're going to have to cut production, and that's going to help prop up U.S. oil producers. And so this is Russia's complaint. Russia's complaint is, look, all we're doing is keeping these guys in business. We need to go ahead and defend our turf here. The way OPEC could win here is if U.S. shale production peaks. So if they cut production and keep propping prices up, at some point U.S. shale oil production is going to peak. Now, if that happens soon, OPEC, that's a winning strategy for OPEC. They could win. If it doesn't, it's a losing strategy. All OPEC is going to do is lose market share, and this is what Russia was saying. And OPEC production has fallen to a 17-year low as they've tried to compensate for U.S. shale production. Now, will they be successful this time? I doubt it. U.S. shale producers are they're efficient. As some of them get into financial trouble, they may be bought up by the Chevrons and the Exxon Mobils. We will see some bankruptcies. We may see more this time than we did then, just because we're starting from a lower point. They don't have as much cash reserves as they had then. Last time we went from 100 down to all the way down to the 20s. This time, they're already running, they're at $50, so their margins are not nearly as good as they were for some of them then, but they have gotten a lot more efficient. And I think that most of them will survive this unless, if we do see oil down at $30 for an extended period of time, which we didn't before. We saw it dip down, but it didn't hang around 30 for a really long time. If we see $30 oil for the rest of the year, we will see a lot of financial pressure in the oil markets.
Yeah, and I think for the larger companies that are patient, there's going to be some bargain opportunities there. Remember back in, I think, October 2019, Chevron was in a bidding war with Occidental Petroleum over Anadarko Petroleum, and Anadarko had to get help from Warren Buffett. Warren Buffett had to inject more capital, and Occidental ended up paying an enormous, they gave Buffett preferred shares, Buffett got warrants, Buffett got, some sweetheart deals. And Carl Icahn at the time was very upset with those deals. But now Chevron has the opportunity, because they lost that bidding war, might be a blessing in disguise for them. They could basically get two companies now for less than the price of the one company that they bid on initially in October. They could get Occidental Petroleum's premium assets there in the Permian Basin, and then also Anadarko Petroleum, which Chevron really wanted, for less than the cost that they bid back in October. I don't know if they'll bid for it or not because of the debt levels, but certainly right. Carl Icahn thinks so, because Icahn just increased, even with the debt, the filings came out, his stake in Occidental Petroleum just increased fivefold, up to 10% this week.
Yeah, I wrote about that for Forbes at the time. I wrote, Chevron, please do not buy Occidental. Do not get in a bidding war with Occidental. When Occidental came in and made that bid, I pleaded with Chevron, please, Chevron, do not get into this bidding war. And Chevron got paid $1 billion. They got a breakup fee of $1 billion. So they came out of it looking pretty good. And you're right, they could actually buy the combined company now, and it would have paid off for them to wait. But I was hoping they weren't going to get into a bidding war over that. I thought that would be a huge mistake, and they would give up any of the synergies that they thought that they were going to get.
Yeah, one other point I forgot to bring up about the last time the Saudis tried to kill shale is with your $1 trillion article there, the $1 trillion miscalculation. That's how much money the Saudis wasted in their foreign exchange reserves, $1 trillion of their foreign exchange reserves to try to kill shale. So, yes, they caused some bankruptcies, but nowhere near the amount that they thought. Now, I want to transition and ask you about a question a lot of my listeners are asking me, because they are looking at oil. They've seen some of these oil stocks crash. The deep water companies have crashed. I'm avoiding any oil stocks right now. I'm not long any oil stocks, for full disclosure. I'm waiting to see dividend cuts. I'm waiting to see if oil prices rise back up, if China restarts. But please tell my listeners about hedging. So how do oil companies hedge their oil production? Do they go onto the futures market and just hedge with futures contracts, or do they do more sophisticated hedging now with options, with things like collars and swaptions and things like that?
I've seen all of that, and there are companies that have stopped hedging. I remember famously when Continental, they let all their $75 hedges roll off, and they said, we're not going to hedge anymore at $75 because we don't think oil is going to stay here. We think it's going higher, and that was a really costly mistake. ConocoPhillips does not hedge at all. And the reason they don't is they said over time that is just a net cost of business. It's a net drag on earnings long term, because sometimes you're right when you hedge and sometimes you're wrong, and we just ride with the oil prices. We don't try to hedge because they view it as a net long term negative, rather than if you hedge and you're right and oil prices fall, you're doing great, but you're not always going to be right, and so that's their philosophy. That was a company that I was really high on. I used to work for them. I was really high on them in January because they have retooled to be profitable at $40 oil, and I don't think any of the other oil producers can do that. So I said, even if oil prices go down and stay down a while, ConocoPhillips will be one of the last men standing. But their share price has gotten cut in half. I mean, they've taken a tremendous blow but they're in much, much better financial shape. I mean, they may have to make some changes to their plans now if oil stays down where they're at, but they were going to buy back and pay dividends almost equal to their market cap over the next 10 years. I mean, they had $50 billion worth of returns to shareholders planned over the next 10 years, and that was assuming $40 to $50 oil. So, that I told people, if you want to invest in an oil company, I don't think anybody's got better plans than that. But, nobody is going to survive and thrive at $30 oil.
While you were talking, I just pulled up ConocoPhillips here on Seeking Alpha, and I looked up their dividend payout ratio. It's only 63.91%. So it's not near 100. It's not alarmingly high. It's actually, their dividend payout ratio is actually below Chevron and ExxonMobil and Royal Dutch Shell.
Yeah, they did cut their dividends several years ago, and they lost some credibility because they had recently said, we're not going to cut the dividend, but they had a change of strategy, and they said, you know what, we want to survive a period of long-term lower oil prices. They shed a lot of their higher assets, their higher cost assets in Canada and some offshore, and they have really retooled to thrive. I always hoped they wouldn't make an acquisition like Occidental. I was just praying that they wouldn't do that because I felt like they'd get punished just like Occidental did. It's not a surprise to me what happened with Occidental. People ask me, should I buy Occidental? Absolutely not. I would avoid them like the plague. Maybe not now. I mean, they've rallied since they announced they were going to cut the dividend. I think people are kind of relieved that they're not going to be going into even more debt just so they can cover that dividend.
It's interesting that Carl Icahn increased his stake fivefold. So it looks like there's going to be some type of a fight over the company now between Warren Buffett, Berkshire Hathaway, and Carl Icahn, and then maybe Chevron or another company comes in as well. Carl Icahn has said he wants to fire the senior management and get rid of the board of directors and then clean up the company and put it up for sale.
Yeah, and there's definitely value there, but you're really going to have some recovery in oil prices, I think, before that value is realized.
Yeah, it's interesting because Icahn doesn't seem worried at all about the debt if he increased his stake that much. But, I mean, the average retail investor, like Carl Icahn's a billionaire, so if he loses on his bets, he's not going to go broke or anything.
Yeah.
But Warren Buffett, only a couple months ago, I've started researching ConocoPhillips because the bidding war and the overpaying and all the interesting things going on with the company. They do have low-cost Permian Basin oil assets, so they do have some really good assets that the super majors like ExxonMobil and Chevron would want. But Warren Buffett was talking, I think, November 2019 about putting in another $10 billion for Berkshire Hathaway because Berkshire Hathaway has so much cash on the sidelines. So we'll see if that happens or not. But Buffett is already $11 billion invested with his debt and his preferred shares and his common shares, common equity, and then the warrants that he has in Occidental Petroleum.
Yeah.
Well, it's two billionaires fighting, right?
Yeah, he got a good deal that you or I couldn't have gotten. I would have jumped on that deal as well.
Yeah, he's getting, a 9% preferred guaranteed dividend. We'll see if he has to renegotiate that to give Occidental Petroleum more cash.
Yeah.
So I want to ask you, what percentage do you think of U.S. shale oil producers are hedged? Do you think the bankers then are giving them some of these loans or revolving credit facilities, some of the different types of debt that these shale oil producers have? Do you think that it was required that they have a certain amount of their oil production hedged?
I'm sure it was for some, and I've read in the past, numbers on what percentage were hedged. I think at the time it was 50-60% were hedged. I don't know what that is today. I haven't seen those numbers in a while.
What worries me the most is that it seems like a lot of these companies, if oil prices do stay low, they have bad debt-to-equity ratios and their debt-to-cash flow ratios are down. So they might need some equity infusion, but there's not the pension fund money to come in and buy junk bonds, shale oil junk bonds, or buy shares of these shale oil companies anymore.
Yeah. Yeah, it's amazing to see the fall of some of these formerly really good companies like EOG Resources and Diamondback. It's amazing to look at where they were and where they are now.
Well, I think EOG has such good efficiency that EOG would probably be a prime buyout candidate, right? I mean, I was just looking at some articles at EOG this week, and there was a lot of good research out that, they can cut their costs and they're still going to be able to cut their costs and maybe break even close to these levels. So, they've been cutting debt now. EOG, I think, has been cutting debt aggressively, paying off debt for the last 12 to 18 months. So it's not like they were over-leveraged like Occidental Petroleum was at one point.
Yeah.
I want to ask you now about oil refiners. So the last time oil prices crashed in, 2016, right, when they went to $20 a barrel, the oil refiners all along while shale oil production was increasing, this was before the big mergers in the refining industry with like Tesoro, I think, getting bought, and Western Refining. I think Western Refining went up over 400% from like 2009 to 2014 or 15 before they got bought. So the refiners normally, when in this environment in the past, oil refiners made money because they had lower inputs. Do you think that this will be the case, or do you think that oil refiners are going to have, like Valero and Holly Energy and Phillips 66, do you think they're going to have problems now?
Yeah, so this is a little bit different than 2014, 2015. You're right. When oil prices plummeted, they were printing money because their margins expand when oil prices plunge. This is a little different because then demand was still growing. And now with this drop in demand, that's also a drop in gasoline demand. It's a drop, not just in oil, but, gasoline, diesel, jet fuel, all those are going to be under pressure. So I don't think they're going to benefit like they did in 2014, 2015, and the market clearly doesn't because the market has pummeled these companies. Valero's gotten cut in half, and Valero's one that has conservatively covered their dividend and increased dividends year after year after year. They've just been a money printing machine, and yet their share price has just gotten battered in this downturn.
Yeah, the top news story on oilprice.com, not sure if you saw this today, is global jet fuel demand down 11% amid coronavirus outbreak. So when you see headlines like that, like gasoline demand is down, travel is down, people are not going on business trips or vacations, and jet fuel is down, that's not good for the refineries.
No, and it's a very different situation than we saw in 2015.
So do you expect the CEO, John Hess, he said on CNBC, you told me you didn't see the interview before we started recording, but he said he could see the rig count in the next 6 months drop 50%. Do you think that's reasonable to expect the rig count in the U.S. to drop that much?
Yeah, I do. I think companies are going to be slashing costs everywhere they can. So, yeah, I think that's reasonable that we will see that drop sharply. I mean, again, Saudi and Russia could come to the table next week, and you could see oil prices surge. They fell faster. I didn't ever recall oil prices falling as rapidly as they did when Saudi and Russia got in this tiff. I was thinking back to the Gulf War, and I knew that prices had spiked tremendously. And following this, they said, the last time oil prices plunged like this was in 1991. I didn't remember that, but I know Sunday evening I was watching the tickers and I saw, WTI gap down 20%, and I said, wow, I've never seen that before. But you could see it gap right back up. If Russia said, you know what, we were wrong, we do want to cooperate, let's make some deep cuts, they could all get together and push oil back up to $50 in short order. But they might have to make some really, really deep cuts. It's like I said about Russia. I wrote an article on Forbes a few days ago. It got more than 100,000 hits, so there's a lot of interest in it. What was Russia thinking? Well, and I explained, here's what they were thinking. But the problem is, yes, they might sell a little more oil than they would have, but it's going to be at a much, much lower price. So they're going to reduce their revenues as a result of this. If they just come to the table and said, okay, we'll make the cuts. I mean, one can argue for understanding why they did what they did, but I've always said the consequences of that are going to be severe. The financial consequences will be severe.
Do you think that they're thinking, so the Saudis and Russia are thinking 2 or 3 years from now that, okay, they take losses for 6 months or a year, maybe 18 months, at most 2 years. They bankrupt a lot more shale companies. China, the global supply chain comes back online. All the problems are solved. We're past the coronavirus issues 18 months, 2 years from now, and the Chinese economy is restarting back up to fairly normal levels with car traffic and travel maybe at most 2 years from now. And then 2 years from now, oil prices are well above $70 a barrel again, maybe up to 100. That's the strategy they're implementing?
Yes, that's the strategy. And the problem is, you know, I've sort of downplayed how quickly electric vehicles were going to really make a major impact. But the problem is that day is coming. It's just, I've always said it's coming a little bit farther in the future than many people think. But while they're playing these games, that future is ticking closer and closer. And so, you know, I felt like the oil industry could have a pretty good run for the next 4 or 5 years as you know, electric vehicles continue to ramp up. Now I'm concerned, you know, if they play these games for too long, they're going to burn up a few good years here that they could have had before electric vehicles really put them under pressure.
Have you heard anything about Iranian oil production? Because, you know, I'm looking at for the news, the truth with the videos that I'm seeing coming out of Iran with the coronavirus, the nurses on social media who are crying over how many people are dead, the people in body bags, the mass graves, that's all over social media here in the West. So has this affected, have you been able to find out if this has affected their oil production, if a lot of their oil production is falling? I haven't seen a news story confirming one way or another that their oil production has been affected yet, but it seems that there's lots of people infected with the coronavirus in Iran, way more than the Iranian government is reporting and a lot of the media is reporting. And eventually, you know, if enough people are infected, it would make sense that their oil production would have problems.
Yeah, I expect that it is, but I'm like you. I haven't seen any stories saying that it is, but I would suspect. I mean, Iran's got some serious problems here dealing with coronavirus. I would expect that will have impacted oil production.
Yeah, I mean, I haven't seen any stories directly linking their coronavirus outbreaks to the oil production yet, and I've been looking for them. So I've been asking my other oil industry contacts, professional traders, and they haven't found anything yet. Okay, well, I want to get your opinion here about low-cost oil producers. So who are some of the low-cost oil producers? Is it EOG Resources? Is it ExxonMobil? Is it Chevron? And how much, realistically, how much lower do you think some of these oil companies can cut their costs and get oil production, and how long do you think it would take?
Well, I mean, I think the lowest cost pure oil producer is ConocoPhillips. I believe that. EOG is probably down there, but they're not in quite as good a shape, I think, as ConocoPhillips. It becomes a little more difficult with the Shells and the Chevrons and the ExxonMobils because, you know, they've got all these other assets, the midstream and refineries, but they are probably all pretty low cost producers. And you've also got to watch, you know, if they're reporting everything in barrels of oil equivalent, okay, are they primarily producing natural gas or are they primarily producing oil? But you know, I've always read that Shell has said that they could break even. They were drilling some wells that they could break even at $20. Now that's not a company-wide average, but you know, those wells are out there still. But you know, probably the average for the industry, for the shale oil industry, the average is probably up around that $50 mark. Probably not less than $40. It's probably in that $40 to $50 range. So, you know, these companies are going to be under tremendous financial pressure the longer this price war goes on.
And which location, for listeners who want to do some research on their own, which location would some of those cheaper cost wells be in? Would they be in the Permian or would they be somewhere else?
Permian is absolutely the lowest cost area. You know, when oil prices start to go up, then you'll see more activity in the Eagle Ford and in the Bakken, but the Permian is absolutely still, you know, after 100 years, it's still producing millions of barrels a day. It is the lowest cost in the U.S. That's the lowest cost area in the U.S.
Yeah, that's what I thought based on my research. And also based on my research, did you happen to see the SEC filings that Diamond Offshore put out in February, a month ago? Pretty crazy, some of the stuff they disclosed.
Yeah, I didn't see that.
Oh, when I was covering oil and energy, Diamond Offshore was looked at as the most conservative deepwater oil company compared to Transocean and Seadrill. And Diamond Offshore basically now has their cash flow negative, and they're about to tap their 2 revolving credit facilities to survive. So it basically looks like unless oil prices rise, they're going to be bankrupt or selling assets for pennies on the dollar in a fire sale in the near future.
That is one space I have consistently avoided throughout my career is the offshores. I've avoided those guys, and I've avoided coal, and those are 2 places. And in hindsight, you'd go, well, maybe you should have avoided oil too. It's oil has not done well over the years, but I always thought that fundamentally, the oil industry, we all depend on oil, and we need it. It's just that we're overproducing it. That's been the problem for years. I'll get in these debates with these electric vehicle folks who say, well, yeah, of course this is happening. Electric vehicles, that's not the problem. The problem is we're just producing too much oil. The demand growth is continuing to be more than 1 million barrels a day year after year after year until this year, until this black swan that is coronavirus. But often I'll see people take credit for this. I said that electric vehicles were going to do this to the oil industry. Well, you're right on the direction of oil, but you're not right for the right reason. I mean, your reasoning is flawed.
Yeah, there's no way that electric vehicles could have done that this quickly. I mean, look at the travel bans. Look at people voluntarily not wanting to travel or even drive in some cases. And
I mean, all you have to do is look at oil demand. Oil demand growth is year after year after year after year. It's going up, and it's not slowing down. I mean, that's what you would expect to see, is that oil demand growth would be slowing down, and it's continuing to go up. 1 million barrels a day, just year after year after year. But this is 100% coronavirus. And then, the price, the demand plunge was coronavirus. The real deep price plunge is Saudi and Russia competing for market share.
Yeah, I see it as they're taking advantage of this. They're opportunists. They're piling on because they see the weakness of the higher cost, over-indebted shale companies. And I called it going for the knockout blow, the kill shot. They're trying what they did a couple years ago, and they're thinking that it's going to be more successful because the capital is not available for the shale companies. Maybe that means most likely my educated guess would be forced consolidation then. So either more bankruptcies or forced consolidation where the executives of these shale companies, even if they don't want to, they sell out for pennies on the dollar to a larger oil company that actually has cash and a better balance sheet.
Yep, we're going to see some of that.
Okay, well, in wrapping up this oil interview, Robert, I have one more question for you. So what would have to happen for you to become bullish oil?
I mean, bullish oil prices, if Saudi and Russia, and they're going to meet. They're going to meet here maybe next week, but they're about to meet, and if they could hammer out some kind of substantial cuts. But beyond that, I think what we're going to have to see is really the coronavirus cases starting to decline. There needs to be some reason for optimism because people aren't traveling. I mean, people are scared to fly. You got empty, Disney's now. I own Disney stock, and that stock has just gotten obliterated as a result of this. You're going to have to see some reason for optimism. You're going to have to see people no longer afraid to get out and get into a crowd again. And I think that's going to take really a serious starting to decline in the cases, and we're still on the upswing here. I warned in February. In fact, early February, I said March is likely to be a very bad month in the U.S. when it comes to coronavirus, and that is turning out to be the case. Our cases have doubled here in the last 3 days. We're increasing about 33% every day, and until that starts to slow down, there's going to be pressure on oil prices. I mean, you got to watch China too and see, when they pick back up and when things get back to normal. If you believe their numbers, they've got everything under control. A lot of people don't believe their numbers, but once they get sort of back to normal, oil demand will start to pick back up. But I think this year we're looking at an oil demand decline that we haven't seen since the financial crisis.
Do you think this is a worse decline than the financial crisis? Because back then China was still growing, right? So things temporarily shut down in China in 2008 and 2009, and then China did an enormous stimulus package, and they started this enormous infrastructure spending plan. So that was consuming a massive amount of metal and oil and energy to build things, infrastructure, buildings, all these different things.
Yes, the demand decline will be worse than it was in 2008. And the stock market decline, somebody asked me, I think back in January, they said, is this the next pandemic? And I said, I don't know, but this is how the next pandemic starts. It looks like this in the beginning. Now, we don't know if this is going to peter out or not, but as it continued to grow, I started to worry, especially at the really extreme curfew measures that countries were having to take. And I said, we could see a downturn worse than the financial crisis, and I still think that's the case. The market sell-off that we've just seen, I was in the market in 87. I saw that. That is the worst I've ever seen. This is the second worst I've ever seen, and we're not finished. So this could be, we may be making comparisons to 1929 before this is all over with. I just don't know. I'm hopeful it doesn't come to that. I'm invested. I stay fully invested all the time. I don't try to time the market. I rode out 2008 and was better for it, and I'm riding this out. But I just hope that we're not. We do have a lot more bad news in front of us. I think if people absorb that and they understand that, maybe the panic will stop, and people say, okay, yeah, there's some companies here that are going to be really good companies coming out of all this, even though, yes, they're going to have, a few quarters or maybe a year here of no profits. But, if I can get a Disney for, deep discount, if I can get Coca-Cola, if I can get IBM, some of these companies that pay nice yields, I can get them on at a deep discount, the people will start to buy.
But in wrapping things up here, back to the oil demand side, you've been in the oil and energy industry professionally, different jobs for 25 years now. Is this the worst demand drop that you've seen in your entire career?
Yes, this is the worst demand drop we have ever seen in a quarter, for sure.
Well, there you have it, folks. So I would still call this a falling knife. I am very cautious right now about being long any oil stocks. There will be bargains. I'm just waiting for the dividend cuts first because we don't know how low the oil price is going to stay. So if we're wrong on timing on this, the oil stocks could get cut down even more. Dividends could be slashed. If dividends are slashed, income investors start to dump. It becomes a vicious cycle because some of these income investors and pension fund investors, if the dividend gets slashed or removed, they can't hold the stock. So, and we haven't seen that yet with companies other than really Occidental Petroleum, and that could still happen.
Absolutely.
Okay, Robert. Well, I want to thank you very much for your time. You've been very generous, giving my listeners a lot of great analysis and insights. If my listeners want to follow your great articles on Forbes or take a look at your investment newsletters, how do they do so?
Yeah, so you can Google my name, Robert Rapier, and Forbes, and you'll find me there. I write 7 articles a month for them. I cover the whole energy space. I have been writing about oil a lot lately, and I've been writing about coronavirus extensively since January and the threats. And then I write Utility Forecaster for Investing Daily, and as well as their weekly Stocks to Watch column, which is a free column. Comes out every Tuesday on the Investing Daily homepage, and you can find me there telling people to be very, very careful in this market.
Yeah, it's been extremely volatile, and it reminds me a lot of what happened in 2008. But the stuff that's happening in the oil market is really unprecedented because, as we've talked about, if you go back and listen to the interview, all bits and pieces from different time scenarios, like what the Saudis had already tried to collapse Shale ineffectively 4 or 5 years ago. and now they're trying it again. But the demand, I think the most important thing is, like you said, is the demand destruction. And when does demand start to return to somewhat normal levels 6 months ago or a year ago?